If you're thinking about becoming an accountant, or maybe you're just trying to learn accounting, these are the 5 absolutely crucial concepts you need to know. Now, I'm a chartered accountant and have spent years studying for different exams and working in accounting. If I knew this when I got started, it would have saved me an awful lot of time and I would have felt so much more confident in my abilities. If you're new to the channel, my name's Callum and I make videos for new and aspiring accountants looking to build their accounting career and future-proof their skills. So if that sounds of interest, be sure to subscribe and we'll dive into the first point. It wouldn't be a video about key accounting concepts if I didn't talk about the bread and butter of accounting, being the debit and the credit. But most importantly, how they actually apply in practice. Because I'm sure you've read all about them in your textbooks and watched plenty of different videos explaining how they work. In the real world, you're not always thinking about debit and credit, but you're thinking about what account is affected and how does it move? Does it go up or does it go down? There's a very simple way to think about this and the way that I actually learned myself. And that's the concept of dead click. Now, dead being D-E-A-D means debit increases expenses, assets and drawings. And the click being C-L-I-C means credit increase liabilities, income and capital or equity. But what does all that mean in practice? Well, let's say you've just started a business and you want to put a bit of money into that business to kick it off. You'll take your £1,000, for instance, and you'll put it in that company, meaning the bank account of that business has increased. As dead click shows, debit will increase assets, so we'll be debiting that asset or that bank account. Now on the credit side, we're looking at the equity account because that £1,000 you've put into the business is your owner's equity. And we know that credits will increase equity as shown by the click. So what we're left with is a debit £1,000 to assets or your bank account and a credit of £1,000 to equity. If we then say lease an office for that business, then we then incur a rental expense. So we are debiting the expense account for rent. Remember, debits increase expenses, and we are crediting our bank account because a credit will reduce an asset account, which is effectively the inverse on the dead click. Hopefully I haven't lost anyone there because this is a very simplified way of looking at things. And in the real world, it gets a lot more complicated, I can tell you that. But ultimately, what you need to think about is what account is affected and which way does it move. Fundamentally, that's all this really is. And if you can get your head around dead click and remember that, it should help you out an awful lot, whether that's in your exams or in the real world. The second concept I want to talk about is the purpose of each financial statement. Because to be honest, you'll look clueless if you don't understand the financial statements and how they all link together. In summary, there are 3 different financial statements. The first being the statement of profit and loss. This effectively shows how a business has performed over time, whether that's a month or quarter if you're doing management accounts or for the whole year in most financial statements. The P&L is really about performance and not cash, which is where a lot of people tend to slip up. It leaves quite an interesting position where a business can show a profit, yet still be struggling with their cash flow and ability to make ends meet. Because income and expenses are recorded when they are earned or incurred, as opposed to when the cash actually moves hand. And this is called the accruals concept, which we'll get onto in a moment. But a lot of junior and new accountants tend to assume that profit equals money in the bank, and it's simply not true. This ties into our next statement being the balance sheet or the statement of financial position. This basically shows what a business owns and what it owes at a particular point in time. It doesn't show a period-long performance, it just shows a snapshot of how that company looks at a certain point. Now, a balance sheet is useful because it tells you whether profits are real and whether they are sustainable. You'll see a company's assets like its cash, its debtors, its investments, but you'll also see the liabilities of that company being the creditors, the accruals, and any loans taken out. The equity is effectively what's left over for the owners of that company. In practice, lenders will use this to assess a company's solvency and how risky it is and likeliness of repayment. Auditors will spend a huge amount of time testing different balances and analyzing the balance sheet to see whether the company is a going concern. And management accountants and CFOs will use it to usually spot working capital deficiencies and solvency of the company. Finally, we have the cash flow statement, which is probably the most misunderstood statement there is. This is where the actual cash comes from and where it goes. It really explains why the bank balance has changed. Now, cash flows are split into three specific areas. You've got operating activities, investing activities, and financing activities. And it's a very important statement because most businesses fail because they run out of cash as opposed to anything else. Because as we spoke about before, you can have profitability, yet still struggle with your cash flow. I'll admit it's probably one of the more confusing statements to get your head around, but logically, once you've gone over a few and perhaps practiced a few, it does tend to make sense. Think of it as just seeing the movement in actual cash, whereas your P&L might show non-cash movements like depreciation or amortization. Your cash flow will simply show the actual movements in cash, things that have been paid for and cash that's come into the company. But where the value lies is how they all link together, because the three statements are definitely not separate. Profit from the P&L will flow into equity, changes in balance sheet items will explain the cash movements, and the cash flow statement is effectively the bridge between those two statements. Now, as I mentioned earlier, the accruals concept is something you really need to get your head around as soon as you can. Most companies' accounts are prepared on what's called the accruals basis of accounting, as opposed to the cash basis. And what this really means is that revenue is recognized when it is earned, as opposed to when the cash enters the company, and expenses are recognized when they are incurred, as opposed to when the cash leaves the company for that expense. It sounds a bit strange when you first hear about it, but logically it does make sense. Let's say you run a business, if we go back to our first example, and your rent expense for March is £500. In March, you use the office for the whole month, but you don't actually pay the rent until April, the following month. On a cash basis, nothing would then be recorded in March because you haven't actually paid for anything. It gets deferred until April when the cash actually leaves the bank. But what the accruals basis shows is that the rent relates to March, which is when you actually use the office. Therefore, you need to match that expense with the period it was incurred, being March, even though you haven't actually paid for it yet. And this creates a liability if we think about DeadClick and what we first spoke about, where we're debiting the expense, the rent of £500, and we're now crediting a liability for that £500 because we've incurred the expense, but we haven't actually paid for it yet. Then in April, when you actually pay your rent, you would debit the liability account to reduce it down to nil, and you'll credit your bank account to effectively show the amount you paid out of the bank for your rent expense, reducing that asset account. Again, it's one of those concepts that you need to spend a bit of time getting your head around and really understanding, but it's absolutely crucial in the real world. My final point is about materiality. Now, materiality is all about understanding what actually matters to influence decisions. It's not about fixing every tiny penny that may be incorrect or an error in the financial statements, but focusing on what actually makes a difference. Imagine you're auditing a company with a £1 million revenue. A £5 error in the stationery account probably isn't going to raise any red flags. But if there's a £100,000 error in that account, you may look at it a bit differently and begin to question what's going on. Obviously, there's a lot of judgment that comes into play here to determine the percentage figure for materiality. But really, you need to be asking yourself, how big is the misstatement relative to the financials? Would it change the decision making of a stakeholder? And is it actually worth the time to go ahead and correct? So there we have it. A few key concepts that you need to know if you are trying to learn accounting or get a job in accounting. Be sure to like and subscribe, and I'll see you in the next video.